This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview.
Podcast here from Stockbox, where today we're joined by Dean Page, the head of advisory at Stark Resources. We're also joined again by Willis Thomas from CRU and his colleague Johnny Lazar from CRU, who work with Stark. They're partners with Stark, the metals markets analysts. So thank you all for joining us today. Welcome back to Willis, but of course, welcome first time to Dean and Johnny. How are you doing?
Yeah, all good. Thanks, Mark. Thanks for having us on the show.
Very good. Very good to be here, Mark. Thanks for having us.
Well, thank you all for your time. I mean, the theme of this podcast really is forecasts and trends for 2024. It's quite good to start doing that at the start of the year. I know we did our introduction podcast. We've got a series of podcasts planned, but we'll start 2024 looking a bit of a look ahead. I'm doing a lot of that with the guys that are coming on Stockbox, some of the companies, what their plans are for the year, and then we'll see in 12 months' time if they do indeed achieve them. But in terms of a general forecast and trends, let's just get an idea really of what you guys are looking at, where you're feeling the sector is. And I mean, if we were to just perhaps, I know Johnny, you were at Future Minerals Forum, or CRU have been at Future Minerals Forum recently. What was the general vibe that you picked up from that?
Yeah, so we had a fairly chunky team go over there, and I think the sense is that there's a lot of willingness and kind of positive attitude towards the market, but it's very regional. So obviously, with it being in the Middle East, that region is teeming with investment activity and a lot of willingness to move things along relatively quickly. Now, if you compare that to what's going on elsewhere in the world, there's a lot more hesitancy in some of the rest of the world. And so there's a real kind of regional contrast that comes across when you go to these big regional powerhouse events, and I think our guys saw a lot of that when they were over there.
Why do you think that is then? Why do you think there's a real regional change here with the Saudis really pushing on?
Well, I think they are really pushing on. You know, we've done work over there, and I've been involved in work over there for the last 20 years, and there's always been talk about pushing on with diversification, but there is a lot more sense of urgency right now. There are some fairly clear targets set, and they've done a really good job now of separating out investment in foreign assets with consolidating domestically and developing the domestic industry as well. And they're pushing on both of those routes, but separately and with very clear targets set in both areas. And of course, they've had 3 years of record revenues from the oil sector that they can kind of fall back on. It's all of this stuff is a lot easier to do when you got cash in hand, right?
Oh, indeed, absolutely. And we know there's a lot of money there, particularly in the oil industry, and that's what a lot of people associate that region with. I mean, do you think they are seeing an opportunity? Well, I guess two things: an opportunity in the mining sector, but secondly, a risk element of oil and wanting to get off that, and they're really now focusing down maybe the transition metals, energy transition metals.
Yeah, and they've been very open about that for several years now. I think it's been accelerated by the fact that, you know, that kind of phase out of oil has clearly been delayed a little bit by geopolitical events, and therefore they've got an even greater ability to essentially put some serious capital that they've earned from the oil and gas industries into mining. And also, I think, you know, they're looking to essentially leverage their cost competitiveness in primary metal processing, but to do that, they're going to need an awful lot of raw materials, and they're very kind of conscious of this and, you know, not shy to put money behind it. And of course, they've got a bunch of giga projects that almost ensure a certain base level of demand for those materials. So it's kind of a nice perfect storm there.
Indeed. Well, I mean, we've had, of course, the Future Minerals Forum recently. We've got Indaba coming up. We've got PDAC as well coming up. Dean, I guess from Stark's point of view, you're going to be attending or representing the company at these events. What are the things you're preparing for?
I think, Mark, one of the things, or just leading back there to the Saudi Arabia discussion, at least on one positive aspect, is around the permitting issues as well. So from 2021, Saudi Arabia has become a lot more transparent in terms of what mineral rights, mineral concessions they do open. They've actually launched a cadastry as well. So normally, what you would do in a country, if you want to go and explore as a junior or as a private, or even as a tier one company, you would normally go into the jurisdiction to see what is actually available, what are the mining companies doing, what exploration targets are there, and so forth. And yeah, so from a transparency perspective, I think Saudi Arabia has become a lot more clear in that. There's a lot more data that's available from an exploration point of view. So if you're any layman wanting to do something in Saudi in the minerals or metals market, that bodes quite well. And transparency is always a good thing. I mean, if you look at cost of capital, if you look at premiums or country risk premiums and all of that, I mean, that, at the end of the day, is that forms part of your economic assessment. And then leading to the mining endeavor from Stark's point of view, it's more or less looking at disruptive technologies, innovation. So over the last, let's say, 2 years, Stark has been embarking on how do we beneficiate and provide hybrid solutions at the end of the day for a particular commodity. I mean, Stark is all about value proposition more than selling equipment at the end of the day. And there was a real nice niche there for the lithium market, or let's say the hard rock lithium market. So I mean, you've probably been tracking Stark's presence over LinkedIn and on our website and social media. And it's really about the concentration factors of, let's say, spodumene or lepidolite or petalite or whatever lithium mineral you'll be looking at, and really targeting on that. So really looking at innovation, technologies that's out there, and how do we use that from a holistic approach in either current flow sheets or potentially for new juniors or whoever comes onto the mining market, what basically is available from a solutions perspective that could fast track the approach.
And as your role of head of advisory, I assume part of your role is to, well, advise that the board of Stark on the macro environment, so they can, in theory, sort of perhaps make decisions or have expectations of what might be coming down the track in terms of the general mining sector, and that'll help them with decisions they make commercially. What's your sense of the mining sector? I mean, in terms of, we're going to have a good year, we're going to have a mediocre year, a bad year. Do you have a sense of where the sector is and where it might be going this year?
Well, currently, just from Stark's perspective, we're getting a lot of interest, inquiries, especially in the battery metals commodities. Lithium, obviously, being a hot one, copper as well, and it's basically all round from North America, Canada, stretching to Africa and Australia. So we're seeing some good indicators there that people are willing to spend money, even at exploration stage, for test works, for studies, for optimizations on brownfield projects. So I think we're seeing a good mix of that, and that shows encouragement in the market. So I believe it could be a good year. Obviously, there are macro factors that are at play. I mean, inflation is one of them. It's currently going down. I mean, I think Q1 and Q2 is quite important, especially for juniors, which is basically Stark's target at the end of the day. And yeah.
Okay.
So
Well,
with a background in geology and being involved in the mining industry for more than a decade, I think that also lends itself quite well in knowing what basically to target at the end of the day, where to look at, and that what innovation as well to do. I mean, there's some cool things that will come out soon, let's say in the next year, which we're basically working on as well with our partners. I mean, that's also the big thing. It's people like Crew, people like our OEM partners from a sorting perspective, DMS, flotation, and so forth. All of these partners, I mean, you at the end of the day want to create a holistic solution for either integration, test work, studies, and all of that. And you want to bring that knowledge together so that you can come up with something that's actually going to be working at the end of the day. I mean, in North America, if you build a plant there, you can't basically use the same specs that you're doing in an African environment or whatever. Same as in Australia. So it has to be fit for purpose for a particular environment, and that's where we want to find ourselves in, to assist. So
Okay. Well, thank you for that, Dean. I wonder if I can get a few thoughts from you on the sector. It'd be nice to perhaps catch up, perhaps after the Indaba and after PDAC, and get a sense of what the vibe was like on the ground, the appetite, let's say, for investing. But how are you seeing things? And I know we're going to talk about commodities specifically in the perhaps the battery metals, those are perhaps the hot commodities. But we've also seen exceptional performance recently in the price of uranium and gold, and that was the talk towards the end of last year. So, I mean, what's your sense in the sector in general?
Mark, is that for me or is that for Willis?
Willis, that's for Willis, yeah.
Yes, sorry about that. Yeah, so I think that these are two of the points which are the hottest in the market right now. In terms of uranium, we look at nuclear as, this to steal Johnny's phrase here, low-hanging ugly fruit when it comes to the energy transition. And there's a growing recognition and acceptance of a larger role for nuclear, as well as the supply-demand balance after years of underinvestment in uranium has really, supported the price in the last year. Further with gold, I think we're seeing a lot of sort of central bank purchasing of gold right now. Of course, the supply and demand balance of gold doesn't really matter as much as the investor or investment side of things. But I think even there's a really interesting story to talk about in the future where we see existing assets running down in the gold space and a lack of investment over the last 5 or so years, where there's probably going to be a bit of a much tighter supply side for gold while demand continues to rise on the physical side as well as investment. And especially, I think there's some new exciting things in gold around gold-backed currencies, which are gaining a little bit more traction now, which, it just leads more people to be interested in the sector again. Of course, we're going to see a bit more of a dovish monetary policy in 2024, which should help support prices for gold. So we expect to see those rising continually. But I think something to tie back into Dion's point about Indaba, inflation is getting lower or is slowing down, but it's not lower. Costs are still much higher than they were a few years ago. Prices are higher, but not to the same degree. So now you've got tighter margins across a lot of the mining sector. And to drive that margin, you can't really affect the price that much unless you're really willing to cut supply on a coordinated basis, which doesn't happen. So it needs to be affecting the margin on the other side by reducing costs, being more efficient, and driving forward that idea there of really becoming, separating a little bit more margin so that you can continue to finance yourselves and continue that working capital, but also to show that it's an investable property. Because one of the things that we see through the energy transition across many things, especially uranium and lithium, is there's going to need to be a lot more production. And without the money behind it, it really can't get there. We can't get to our goals at a global level without the sort of local financing that's needed for these mines to come from junior and exploration all the way through to production. And it's no longer the majors who are really financing that exploration or development. There's a lot more focus on M&A across the sector rather than there is about purchasing, a project that's just about to come into production. So I think those things mean that we are going to, even if there's sort of a downdraft in prices from the last couple of years in some of our major commodities that we'll speak about, there has to be an eye to the future that these prices need to rise and that costs need to be kept in control.
And you mentioned gold there, that you think central banks are buying up gold. Why would the central banks be buying up gold?
So we know that certain places are buying gold right now. What their intent for that gold is, we don't know because it's not necessarily an official policy. We've certainly seen evidence of the Chinese central bank purchasing more gold, the Turkish central bank purchasing more gold. Part of that may be around inflation. They may have multiple reasons of why they'd like to stock up on more of that. And it may be, the beginning points of if they expect a gold-backed currency at some point to be, out in the market to have that physical backing there. So yeah, that's some of the stuff right now that's helping to support that price, as well as a lot of
that they might release like a BRICS currency that's gold backed, maybe.
Mm-hmm. Yeah, there are certainly some people talking about that. I don't think that's any official document there, but it's certainly something that is bandied about. And of course, these conversations come up from time to time, so it's not like this is the first time we've heard this. But certainly, that once that gets out in the market, people start buying. You buy on the rumor, not necessarily on the news.
Indeed, yeah. And with uranium, I know we will get on to global inventories in a moment, but just as a sort of a segue into that, the uranium price, you say, a significant underinvestment over the years, and of course that leads to supply deficit. I think I read that Kazatomprom, they actually can't fulfil their existing contracts. Is that right? They actually don't have enough to fulfill existing obligations.
So I didn't particularly read on that. I don't know if Johnny, that you could speak to that a little bit more.
Yeah, I'd say that's tight, but then also the kind of enriched uranium that gets used in a lot of the nuclear power stations, the sort of high assay, low enriched uranium market is very tight. Most of that was being produced within Russia and is now not available for export. So there's we're talking about, hundreds of tons rather than any of the usual kind of bulk commodity numbers that we're used to. But we're talking about the fact that market is very tight, and there's a lot of investment being planned. We've heard news of it in the US, in the UK, and then broader in Europe and Kazakhstan as well, to essentially develop some of that processing capacity domestically away from Russia. So I think that's going to start to bite more and more, and it's part of this trend where, there's been talk about critical minerals for about 3-4 years, but the criticality of those minerals hasn't really bitten yet. A lot of that upstream capacity has been developed within China in anticipation of future demand, and therefore there's been very little urgency outside of China to develop that kind of upstream capacity, whether it's uranium or graphite or any of these metals. And as every year passes, some of those bottlenecks are going to start to bite into the ability of the market to deliver the downstream stuff that everyone's been investing in. And I think that's going to be one of the topics that's going to be discussed both at Indaba and at PDAC.
I mean, general underinvestment in the sector's probably been the case for a while. Typically, it's a cyclical sector, isn't it, that goes through effectively a boom and bust cycle of oversupply and then undersupply. I guess it takes something. So, I mean, if we were to talk a little bit about inventories globally, my guess would be that we're probably in a bit of an undersupply situation, and perhaps one by one, as demand starts to come in, like uranium, for example. I mean, what's driving that price apart from the undersupply? Is it the fact that governments want to invest in more nuclear power?
Well, I think there's been a gradual recognition that across the world you can't make energy transition happen without some level of nuclear power there. And there's some case studies where nuclear power can be deployed fairly easily and more kind of cost effectively than some of the other solutions out there. So a couple of things that you can look at, the US has several projects on the go at the moment to replace disused power plants, fossil fuel power plants with nuclear reactors. There's a memorandum of understanding for Nucor, the steelmaker in the US, to essentially have most of its power supplied from modular reactors in the future. And the fact that the nuclear energy has been designated as green by the European Union means that they have access to the financing that's essentially allocated to green technologies. All of those are signals that that there's a gradual admission of the fact that solar and wind can only take you so far, and therefore you're going to need that capacity to come from some of that capacity to come from nuclear.
I didn't know that the European Union had classed uranium as green. I've been saying it should be classed as
nuclear
green.
power is green, so nuclear power has been designated as one of the green technologies within Europe, and that was
a recent declaration.
Yeah, that was about a month ago, I think.
Right. Okay. There we go. Good.
So
it'll be interesting to see what Germany does. I mean, after decommissioning 20 of them just post the Japan tsunami.
It puts France and Finland, which are the two countries that have really kind of embraced nuclear power historically, in a very strong position to essentially develop a lot of industry that wouldn't have otherwise been developed, and class it as green. I mean, obviously it's low emission, but the fact that it's now you're able to designate it as green means you have access to incentive funds that aren't otherwise available. And again, that's all downstream, but then you're going to need the uranium for that. And it has big implications for steel and aluminium demand as well.
Okay. So, I mean, would you generally say that we've got a bit of an undersupply across not just the battery and the transition metals commodities, but the whole of the metal sector?
It's a point in time thing, isn't it? Because in some of these materials, particularly in battery metals, there is oversupply in China, with capacity
Right.
being built well ahead of future demand, and demand is gradually eating into that oversupply at the moment quite rapidly, really. Whereas in some other cases, there is an obvious undersupply at the moment that needs to be addressed a bit more urgently. But as Dion says, it's a very cyclical environment. So, you know, the pipeline's usually fairly lumpy. So, you know, there's just been a lump of additional supply brought on stream or announced in lithium. Obviously, that price has become very volatile as these kind of lumps of investment come through. And you see the same in graphite. Graphite's a prime example of a material that we all know we're going to need, and yet is oversupplied in China, undersupplied everywhere else, and the price stays depressed, even though there's a clear understanding that the material is going to be badly needed in the future.
And the percentage of volume actually required within a battery, or
Yeah.
let's say in a NMC battery.
Yeah.
That's very interesting, that lumpy pipeline, because I was going to sort of ask about prices, and people investing in lithium know that the lithium price is very volatile, and you're saying that's effectively driven by this kind of lumpy, it almost goes, lots of supply, then suddenly not a lot of supply at all.
Yeah, and it's you know it's typical of any market that's at that early development stage where, you know, future demand is going to be multiples of what it is currently, and it's the sort of we used to call it the Wild West phase, where, you know, everyone jumps in at once, and the timing of investments and the timing of demand don't ever quite match up in the way that you'd hope them to.
Also, it's also all the gigafactories that's going up now in Europe,
Mm.
North America as well. And what's that going to do to China? Because at the moment it's a bit of monopoly. And once these processing plants are up and running, what is that going to do then with China in terms of pricing wise?
I mean, we see a lot of companies that we obviously talked to, a lot of mining companies, and a lot of companies now have got lithium projects, as you say, perhaps that Wild West jumping on that situation. Willis, did you want to make a comment on that? I saw you perhaps.
Yeah, so I think it's really interesting because it's really hard to say as an overall sector if it's undersupplied or oversupplied, because it's so different based on exact commodities. And two that we haven't really spoken about a whole lot here, but very much in the energy transition, that are telling exceedingly different stories at the moment are nickel and copper. So right now, nickel's fairly oversupplied. Price is going to have to adjust to that. But on the other side, copper, while it hasn't moved decisively in the last few months here, the next couple of years are really going to see, quite a bit of a deficit first, in 2024, 25, and then further down the line, there's a much larger supply gap that needs to be covered in copper. And so these are really showing two different signals at the very moment for 2024 and beyond. Even though demand for both will rise significantly, it's really about the supply action on the other side. We've certainly seen that in lithium and how people are reacting. And certainly we're seeing producers or prospective producers change their plans amid the mounting oversupply and the price volatility here to make sure that they're aligned with the market, which I think is really key for anyone coming into this space, is aligning with the market. A lot of times a project is based around a technical timeline, when in fact a market timeline is also really important. Hitting in the right year for first production, in a year that it is undersupplied, is much more advantageous rather than coming into a very oversupplied market.
Is it difficult then to take the sector as a whole? Do you almost have to take it commodity by commodity?
Mm-hmm. A little bit. You can maybe put some things in baskets, but I think if you're not looking at the fundamentals of each one, even gold to a degree where the fundamentals don't matter as much, I think you still need to really look at that and understand it on an individual basis. Of course, there will be trends and, it's average one way or another. But, if your legs are in the freezer and your head's in the oven, the average really doesn't matter that much to you.
Sure.
Yeah, and you see it very much in the difference in the supply side response, right? Because you can build a lot of modeling and a lot of kind of projections around the demand side that will be common and consistent across some of these commodities. But then the supply response rate is very, very different. Nickel and copper are very good examples there that Willis mentioned. Lithium versus graphite's the other one. They're going to be driven by exactly the same things on the demand side, and yet the supply response is completely different between those two.
Right. Yeah. Okay. Could you kind of make the case that the tide is coming in, so all boats are going to rise generally, but some will be speed boats and some will be rafts?
Well, it's certainly the case that we had a year 2022 and the first half of 2023, I'd say, where the tide was so high you would have done really well not to float. It was an exceptional period where I think we saw record prices across all the commodities. But that was very kind of, there was specific things that were driving all of that. Whereas now we see different reactions to the tide going out, where some commodities are staying at a reasonably high level and still bringing in good returns, and some others are feeling the bite of an uncertain macro context, together with the sort of volatile nature of the supply response.
Well, it's getting to that nickel comment you made on the oversupply. Is that also due to different technologies that's basically being employed by the East, like the LFP, lithium phosphate batteries being more used than what the nickel batteries are being used as?
Yeah, I think that's definitely part of the discussion here. When you look at it from a cobalt side, they're definitely being thrifted. That metal is being thrifted out of batteries, so the supply continues to go on because the nickel and the copper mines have been generally profitable over the last couple of years. So there's a little bit more there. But yeah, the changes in battery chemistry, I think, are absolutely going to impact nickel. Certainly, if you look at this 5 years ago, the projections for LFP and share and volume was still going to rise, but share of market was going to decrease. And certainly, that's not been what's ended up happening as LFP takes on a much larger role inside the energy, the EV battery race. And I think that's always going to play a major part in the demand for these battery metals that are especially used in the cathode. Because they're more likely to change. Certainly, there are substitution and augmentation threats from things like silicon on the anode, but it's really the cathode side that seems to have the most evolution through time. And certainly, we expect that to continue on, where the demand projections for volume of EVs continue to be exceedingly strong. Macro headwinds around the automotive production and automotive consumption, or purchases, they've not been very strong, but EVs continue to fly off the shelves. And so I think that that's going to be the underlying driver, but then there are nuances in there based on each particular metal and the supply demand there, because it is such a price sensitive environment when you're talking about batteries being a larger portion of the EV cost. So they're much more attuned to any moves in the price of those materials, and that will dictate decisions around chemistries, because it's not just a technical decision, it's a techno-economic decision of what battery to use.
Yeah, exactly.
And I think it's also got to be very, we've got this kind of divided world at the moment, haven't we? That kind of East versus West thing. And one of you mentioned that there's oversupply in China, for example. But does that affect the prices globally? Because my guess is that the Western sort of governments, Western companies don't want to be securing the supply of, let's say, battery metals for American made or European made and sold automobiles from China, for example.
Yeah, but in some of these commodities, there's no real choice at the moment, because the early development has been all in China. So, it's certainly the case that I think everywhere in the world, there's a consensus that global supply chains are healthiest where you don't depend on one supplier. But then the fact that supplier has brought on stream so much capacity is a real deterrent from people being incentivized to invest in new capacity, because there's so much uncertainty around the fact that if you bring graphite capacity on stream right now, for example, and there is already an overhang of capacity in China, will that capacity be made available for export, and how will different jurisdictions respond to that material being available on the export market? That really puts a dampener on anyone looking to invest in new mine supply outside of China, even if that material is not necessarily open and available at all times to the whole world. So I think, and we're seeing that in a number of different commodities. So it's true in iron phosphates as well. So the phosphate element of the LFP is hugely oversupplied in China, probably undersupplied and tight elsewhere. But the overall price in the market remains pretty depressed because there's always that threat of overhang of supply from China. That if it's available to the whole market, then it really puts anyone off investing too heavily elsewhere. And I think that's been a factor of, you'll hear this at Indaba next week, but it's a real thing in terms of developing African reserves and resources. There's Africa's about a quarter of critical mineral reserves in the world for a number of these commodities, and yet outside of Chinese investments, it's very hard to get anything off the ground at the moment. And that's one of the things that's really dampening that kind of enthusiasm for new supply, particularly in greenfield developments that are very capital intensive.
I mean, where do you think we're going to see a lot of the supply come from? I mean, you mentioned Africa there. That's very underexplored. But of course, North America, there's perhaps more challenging regulatory environment, maybe some more challenging terrain to deal with in some areas. But there's still quite a lot of underexplored areas, particularly in sort of the Ontario area of Canada, for example. So, I mean, do you think any particular jurisdiction going forward will? I mean, we obviously talked about Saudi at the start, and I was going to ask whether that was, the Saudis opening up for exploration within country, or whether they're actually looking externally to invest in projects to bring money into the economy. What jurisdictions are going to be the ones to keep an eye on, do you think?
Well, I think Saudi is a really good example of someone who's going to do both, right? They're going to develop domestic capacity, but they've also got the capital power to essentially deploy that capital elsewhere and make some serious inroads. I think North America is interesting because the resources are there, particularly when it comes to lithium and mined graphite as well, and a few other. There's still copper deposits there, and some of the sort of more minor metals that are still important in the energy transition. The difficulty in North America, for example, is that if you don't integrate that mine capacity with processing capacity, it's very difficult to make the case for economic viability. So if you have to send the material to China to get it processed, it's very difficult to get it passed. On the other hand, if you try and integrate the processing facilities on site, A, that's not always environmentally acceptable, and B, that triples your capital intensity sometimes, and that makes it very hard for a junior mining company to raise that capital. So there's a little bit of a stalemate that goes on in areas like Canada, like even Australia, and certainly in Africa, where you say, okay, well, you don't just have to develop the mine, you have to figure out what you do with the material. And if the answer for that material is, well, it's got to go to China, well, there's a lot of insecurity and investor wariness around all of that.
Yeah, and the Chinese are well set up, are they?
Yeah.
Yeah. Go on, Willis.
And I think that's maybe why Saudi is such an important thing to discuss here, because they are really pushing a more holistic approach, I think, with this, and they have the capital to be able to deploy across the value chain, where some other places don't have maybe the tools in their toolkit, the carrots or sticks that are needed to develop that across the entire supply chain, because it's not just mining, it's initial processing, it's further processing, it's sort of mid to end product production. And rare earths is a great example of this, where there are mines in the US and projects in the US, but to have separation is only just beginning now. But then the further, metal production for NdPr metal, as well as magnet making, those are currently not available at all inside the United States. So to develop that, you have to develop many legs of this stool rather than just one.
Okay. I think that's very interesting, because the North America, even places in Europe might have, or indeed Australia, as we mentioned, they might have the resources, but the actual processing capacity. Is it fair to say, do you think that the Chinese are way ahead of the rest of the world in that regard?
I think they're ahead in a few areas that are fairly key. They're not ahead in every respect, but they're ahead in access to capital. They're ahead in access to readily available capital, even if it's not necessarily cheap. They're ahead in having a track record of developing these projects successfully over the last 10 years, while everyone else kind of sat around and waited. And particularly in primary processing, they kind of dominate a few of these value chains in terms of their their capacity to do the primary processing, as Will has mentioned. In rare earths, they're over 90% of separation capacity. In most of the cathode active materials, they're more than half of the overall processing capacity. And so they have both the kind of technological know-how, but the execution know-how of knowing how to bring these projects on stream. And then obviously they've also got an end-use market that's readily available to them. And also the fact that it's, a lot of these sectors have been defined as strategically important. So they have a very friendly jurisdiction in which to develop all of this. So that's a multiple whammy that's hard to find elsewhere. That's why Saudi Arabia is such an interesting example, because you have a lot of those same advantages there, minus the operational experience.
Mm-hmm.
It's going to be interesting to see if Saudi is going to mimic that what China has did over the last 20 years. And also securing their own demand for battery metals and critical metals for that factor, for that matter, and looking at potential jurisdictions like Africa, potentially North America, and so forth. I think last year at the Indaba, there was quite a large presence from themselves as well, at least from Ma'aden's side, which is the SOE for Saudi Arabia in terms of their mining side.
Well, this year, obviously, they've got the capital investment vehicle called Minara Resources, and that's PIF financed, and Ma'aden is participating in that. But that investment vehicle is specifically aimed at kind of foreign investments to secure raw materials. So that's a clear statement of intent right there.
Yes, and didn't they just open up or say that they were going to have a metals trading arm so to allow them to do offtake financing for this? So
that's what they're looking at.
Yep. Mm-hmm.
Right. Okay. So these guys, are really going to be serious players going forward in the sector. I mean, the next, the obvious sort of question is, how do people who operate in the space, i.e. businesses like Stark, for example, who are looking for commercial opportunities within the mining space, and of course our audience, investors who are looking for good returns on investment in the next few years. We've talked about a few commodities there, lithium, gold, uranium, nickel, cobalt, copper, graphite. Manganese we didn't actually talk about, but it was on my list as well, because of course that is involved in the battery metals there. But it comes back to, how do you know which ones to go for, which projects to go for? And it comes back to that question, that sort of saying that you follow the money, I suppose. Where's the money going? And I don't know if we can answer that question, but I would be keen to get your thoughts on what's perhaps going on sort of globally with perhaps hedge funds or governments, because I've certainly heard, and some of the companies we deal with in the United States who've got sort of like a tungsten project, for example, they could well get funding directly from the US government to develop a homegrown tungsten project. That's serious when a government starts, like the United States is going to start actually putting money into investment, or juniors. It's a junior company. So, I mean, thinking about where the money is, mergers and acquisitions, I wonder if I can get perhaps your thoughts. I don't know if we can actually define, and say, right, okay, lithium's a great commodity for the next year and you want to be looking at projects in this jurisdiction, but anything to kind of get the cogs turning on perhaps where some of these opportunities could come from. I don't know who wants to go first. Just shout up.
I can go while the other guys think about it.
Sure.
So for me, it's very much it's very much looking not so much at what but where at the moment, because the sort of regulatory environment moves very differently in different geographies, and then the incentive money and how that's tied into how accessible that is very different in different jurisdictions. You mentioned the US there. I think the US is a rare example of the sort of regulatory framework that clearly says, here is some incentive money that's available under the following conditions. And some of those conditions are very much, the raw material has to be exploited within the country. It has to be run by a domestically based entity. It has to have certain ties into the other parts of the value chain. But there are some strings there attached to that incentive capital available, but it's clear that the incentive capital is available, and you're already seeing some of these junior mining projects progressing quite rapidly in the US in a way that they really aren't in Europe or elsewhere, really. So it's very much about find yourself a jurisdiction that's clearly stated under what terms it's going to provide some of that incentive money, and also find yourself a location where that link between criticality and economic viability is made clearly, right? It's plenty of people can say, okay, copper's one of the critical minerals, but if you can't back that definition of criticality with some form of commitment to support someone who's willing to put money behind it, then that means very little, right? So any evidence of commitment to supporting the development of critical minerals at regional level, I think, is something that should really be looked at, because a number of different jurisdictions are starting to understand that link between, if we don't develop this mine capacity now, we're not going to have the feedstock for downstream industries in the future. And it's a realization that's only starting to hit now. So over the next 24 months, I think spotting the jurisdictions that take the steps to prove that commitment, I think, is absolutely key. And then it's not just jurisdictions, but also entities. We're about to publish a paper on the importance of MDBs, of the multinational banks and the different arms of the World Bank, and their importance for development of projects in Africa. They've been very vocal about wanting to develop and to support development of critical commodities. But so far, that hasn't really materialized in any sort of commitment, financial commitment. So, I'd be looking out for anything like that, because it can really signal a reduction in the uncertainty level, the risk level, and then a willingness of, Western commercial banks to lend to people willing to make that step. And then the final thing I'd say is, we started the discussion today with this, but you have to prove your commitment to turn reserve into production in a way that, the junior sector will have to prove that commitment to follow through to operation of a mine. And that's hard to find.
I liked what you said, not what, but where, because that's a very different sort of question. And I mean, just listening to what you said there, the jurisdictions that have that framework, that financial commitment, at the moment, is that only the United States then, would you say?
Well, I think Saudi Arabia is an interesting one.
Yeah,
that's another example. There's a few legislative initiatives in India and other places in Southeast Asia that signal the same kind of commitment.
So Europe is the same. I think Germany has got great strides currently to put investment in Africa.
Yeah.
I mean, one large project from a renewables perspective is that Darus Green project in Namibia. So they definitely want to foster a relationship within Africa. But it's like what you said, risk of capital, cost of capital, what is actually in the ground, premiums in Africa, and so forth. It all plays a role. Community engagements and so forth, and then supply chain management as well. So there's a lot of factors at the end of the day, depending on what jurisdiction you are. And at the end of the day, it's about the techno-economic assessment and what's actually going to work. I mean, if you look at the life mine cycle and permitting within Africa, you might be able to bring up a mine quite quickly, or a small little mine quite quickly. But what do you actually then do with that product? Does that go to China? Does it go to Europe? Where does it actually go to? So it'll be interesting to see over the next couple of months within the Western world, in terms of the supply, where does it actually go to? And what off-takers are actually being agreed on, other than just in China.
And I think that's key for the where is whomever is going to produce or bring on a fuller value chain. It's much less risk if that is all a domestically produced value chain, rather than, as Dion said, something where you might be sending, very low grade or even high grade concentrate and exporting that to a processing destination. If that's all in country, there's a better chance that that's going to continue on, I think, rather than having the only export led. Not that, you can't have examples of both, but I think that's something that we're certainly looking at from an overall development perspective of, these metal market value chains, is how and what jurisdictions are looking not just at the exploration and development stage, but also then looking at financing for the processing steps that we've recently spoken about here.
For us, like in the jurisdictions like Australia or North America, where you've already got your fixed plants, fixed operations and production environments, to bring on a new exploration project from discovery phase will take X number of years. It will be quite long. I mean, ESG is a big factor, or environmental is a big factor there to actually get it into production. So for us, it's more about the optimization there of some of those plants. Really, when you look at decreasing ore grades from some of these producers, like what you said there, Willis, the decrease in potential in grades, if it's a copper deposit, gold, or whatever it is to look what do you currently have on the ground and where can optimizations be made so you can still make your buck at the end of the day. So again, it goes back to economics.
But there is also, I mean, that there's not been that many clear successes or great startups recently in terms of greenfield mines, but there's been a few. If you look in Africa and Botswana, Namibia, again Saudi and around there, Oman, and then Australia and Canada. There's been plenty of precedents set in terms of successful startups that you can look at and say, well, what went right for those guys, and where can I look at that being replicated? You've got a copper startup in Botswana that was next to nothing 10 years ago and is now on its fourth or fifth expansion. I think learning some lessons from the successful precedents is something that there shouldn't be as hard to do as it is right now.
It's like Kamoa in the DRC. And 10, 20 years ago in the DRC, not many people wanted to operate within there. Now it's like when you fly into Kolwezi, it's like the destination to go to.
What was that company in Botswana? Can you say the name just so perhaps people can research it?
I mean, the mine's Kuprick Canyon, and its various expansions. But that to me is a real success example of something that's been developed relatively quickly by copper industry standards and with multiple successful expansions, and with predominantly Western capital. So.
Okay. And what do you think's going on? I mean, it's nice to look at the bigger boys, isn't it? The big miners there, like Rio, like Glencore. Is there anything going on in sort of the M&A sector at the moment with these guys picking up the juniors or the mids?
We haven't really seen as much interest in certain places. Of course, in gold, certainly there's been a lot more M&A interest, but across the board for the major miners, certainly there's some more targets for pieces and parts as prices go down and now margins are tight. Reorganizing a business or anything like that certainly is part of a lot of people's sort of musings around this, especially as profitability goes down from a couple of years of very high profitability now to lower profitability. So yeah, I think that's going to come up a little bit more in the coming years, but also I think that the focus on M&A really needs to move to a focus on exploration and development because of the long-term narrative in these markets. So yes, some reorganization of assets and some reorganization of pieces is most likely to happen, but coming forward, that really needs to switch over to financing of production development.
Well, gentlemen, thank you very much for your time. And we could keep talking for a while, I think. There's an awful lot we can talk about. I know before we started recording, the three of you were having a very sort of catch-up on various things that are going on. It's certainly a very interesting space that's always changing. I wonder, and I am going to put you on the spot, but you don't have to take me up on it. But I wonder if I could go round the room and get, if I could, if you're willing to say, what would be like a prediction for the year, something that would be stand out, or something that you think could really happen this year. I don't know if you want to name a commodity. Do you think it'd be a standout or particular project, for example? If you're happy to do that, but also I'd like to get an idea of the window of opportunity we're looking at here for investors in this space. We talk about it being cyclical. Where are we in that cycle? Do we have I talked to someone last year, a commodities investor, and he said it would be one of the greatest times to be alive, and we've got to create the investment of 6 United States in the next 10 years if we're going to go down the green shift, probably the next 30. Where are we in that cycle? So 2 questions if I can. Where do you think we are in terms of the window of opportunity? And if you're willing to say something that, to sort of stamp your name on it for 2024, that would be great as well. So Willis, let's start with you.
That'll be great because I need to vacate this room in which I'm in, so I'm going to have to leave directly after this question. But I think my first answer would be it's going to be volatile. It really depends on the commodity you're looking at. There's definitely going to be some things like manganese, which you only briefly spoke about, where pricing has fallen and it's likely to rise very quickly or in the next little bit here because of the increased demand there. So I think that's one to really watch out for here, that it's sort of hitting its bottom and coming up on the other side. So I think that's probably what I'm looking forward to the most in 2024 is, volatility across a lot of these as they recognize both the current supply demand, but also the future narrative. And with that, I'll have to drop off. So thank you very much for having me today.
Thank you very much, Willis. Take care. Johnny, let's go to you then.
Yeah, it's interesting to be put on the spot like this because I don't know if I've previously thought of an answer. Mine might be a little bit unfashionable, but I'm really looking forward to seeing more green primary processing capacity being proposed for metals that are very power hungry and emissions intensive. So, you're talking 55 to 60% of primary aluminium capacity, 70% of silicon smelting capacity, a large proportion of magnesium smelting capacity. All of those are at the moment coal-fired. And there's going to be serious premiums available in the market for anyone who proposes anything other than coal-fired materials. So whether that's recycling and new ways to recover secondary material, whether that's hydronuclear or renewables-based smelting, I think there's going to be a few things that are going to be going on in that space, and we're going to be watching with a lot of interest to see what drives that, whether it's the regulatory side or whether, as we suspect, it's going to be the willingness of some industries to pay a green premium for low emission material.
Okay, so looking for more greener processing effectively of some of these commodities. Okay, fantastic. And Dean, then let's finish with you. We'll give you the final thought on this.
Yeah, Mark, I would like to seem to be optimistic and quite bullish at the end of the day. And I mean, as we started this conversation as well around the Middle East and Saudi Arabia, for me, the most interesting this year is to actually see what's going to develop there. And based on what's happened at this recent conference, is to really see from a investment perspective, what do they do in country and potentially at projects within Africa or North America or Australia. Are they willing to either invest in juniors or what do they basically want to do? So we're really looking forward to what's to come for Saudi. And then, in terms of just projects and looking at juniors, I'd really like to see more, let's say, the conversion rate between exploration projects and development of projects in general to production phase. I would like that ratio of, let's say, 1 in 1,000 to become a bit more, let's say, more clear or more narrow, due to better due diligence, better transparency, better trade-off economics, and so forth. So we can support the mining market at the end of the day. And that's basically our job, or one of our jobs here at Stark, to facilitate something like that as well, is to look into these studies and see where does it actually make sense to either decrease OPEX, look at technology advancements, innovation, and so forth, to really drive the conversion rate between project and production.
Well, thank you all for joining us today. It's been a very nice discussion on the sort of predictions and forecasts for this year. We'll be talking again, I'm sure. We've got a few more podcasts together where we're going to focus more on specific commodities and go into some more detail on each of the commodities, what drives them and their supply, and perhaps some of the projects to keep an eye on. But for now, thank you all for your time.
Thanks, Mark.
Excellent, Mark. Thanks for having us. See you soon, man.
Cheers.
Cheers.
Okay, cool, great. Thank you both.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.